Hey everybody, Eric Wilson with I Sell Health Incorporated. Hope you're having a fantastic day. I want to talk to you today about the open enrollment period for the 2015 season of the Affordable Care Act, or Season 2, if you prefer to refer it that way. The Affordable Care Act, sometimes known as Obamacare, the Patient Protection Affordable Care Act, whatever you want to call it, is ready to start. This year, the open enrollment season will begin on November the 15th. Rates have not been released yet. I'm hearing November 4th, November 7th, November 10th, all in that area there. I'm guessing sometime after the 4th and by the 7th for most people. That would give us about a week to look at the prices before you enroll. Here's what you need to know. It gets confusing. So people hear the bronze, the silver, the platinum, the gold. How's all this stuff calculated? What do I really need to know? So what most people know about insurance is the deductible and the copay. That's all they really know, and there's a lot more to it than that. Uh, so we'll start with, first of all, how do they come up with these bronze, silver, gold, platinum tiers? All that is based upon what's called the actuarial value, or the AV. That is basically what percentage of the plan will the insurance cover. You could have, if it has 100% actuarial value, it's a plan paying 100% of the plan. You're paying nothing. You got except other than the premium. A lot of the bronze plans are in the 70% actual AV. That is not necessarily the deductible or the percent or the co-insurance. That's the kind of the total percentage of the plan. So, and same thing with silver and the bronze and all the way through and platinum. Okay, so that's what you kind of need to know on that thing. That's something I wouldn't concern myself too much with that. What I would be looking at are these, four or five things. First of all, what's covered by the plan. When you look at that, you pass the deductible and the out-of-pocket maximum, that kind of stuff. Look at what's covered. You'll see some plans. Well, first of all, on all plans, preventive care is covered. So an annual physical, pap smear, mammogram, school physicals, all that stuff is covered at 100%, regardless of what deductible you choose. Regardless if you have a plan that doesn't even cover copays, the preventive stuff is still covered. That's in the law. That's number one. But what I mean by what's covered by the plan is some plans you will see when you look at the testing or the blood work, you'll see, it may cover the first $500 of blood work or MRI, CAT scan kind of testing without a copay, and not apply to the deductible. So some plans have that. Some plans will apply all that stuff to the deductible. Some plans will cover the first, have a different deductible for that. Maybe the testing has a $50 deductible or copay, and then cover it a different way. So you have to look at that a little bit there. Again, that's usually a minor thing. You usually don't have too many blood tests done in a year, too many MRIs, too many CAT scans. That's a smaller thing, but that's one of the things you may want to look at. Okay. Then you look at the cost of the plan. And when I say the cost of the plan, I don't mean just the premium. Too many people look at the premium and say, well, I want the cheapest plan. Well, what's really the cheapest plan? If a plan has we'll just use simple math, $1,000 premium and a $12,000 deductible, or there's one that has a $1,500 premium and a $12,000 out-of-pocket max, and the other has a $5,000 out-of-pocket max, which one's really cheaper? Which one really costs less? You have to look at all those things. You have to look at, when you look at the cost, you're looking at how much is the copay, what's the deductible, most importantly, what's the out-of-pocket maximum. A lot of the plans under the Affordable Care Act have a family out-of-pocket of over $12,000 per year. So that's a lot of money to look at there. So you have to look at in two terms. Then you also look at your personal health history. If you're for the most part a healthy person, you may be okay with a higher out-of-pocket, especially because you may never get there. It's more of a catastrophic type thing, and that's okay. But that's what you have to look at there. The deductible, that most people are aware what a deductible is. A deductible is what you pay before the insurance kicks in. So if you have a $6,000 deductible, hypothetically speaking, other than preventive, because preventive is covered at 100% regardless, but other than that, you're paying the first $6,000 before insurance kicks in. If you have a copay plan, you just pay the copays. That's also not subject to the deductible. So it kind of depends on the plan that you're looking for. Some people don't see a doctor hardly ever. Some see a doctor on a monthly basis. So that kind of depends on what kind of plan you're going to want. All right. The next thing you have to look at, and this is very important, is if your doctor or hospital is part of the network. Under the law, we've seen a lot of insurance plans cut out of the networks. What a lot of companies have had to do to keep the plans affordable is they had to streamline their networks, have a fewer number of doctors to keep the cost down. So that's very important. We had that last year. We had a problem with, especially I'm in the Chicago area, we had one carrier who a lot of the doctors and hospitals jumped out of the network, and that caused a problem for the policyholder because they went in on the premise that it would be in there. Some companies you have to look at also have multiple networks. Blue Cross Blue Shield of Illinois is a great example, and there's nothing wrong with this. Okay, I actually kind of like the strategy. But Blue Cross Blue Shield of Illinois, they have what's called their Choice Network, which is a smaller network of doctors. You pay significantly less money for this plan than you do for the traditional PPO. Now, some people don't care who the doctor is. If you get sick, take the lower cost plan, and if you get sick, find a doctor. Just make sure there's a hospital somewhere near you, and that's okay. The problem is if you have a doctor that you want to see, and you've seen it, or if you have a chronic condition where you've seen the same doctor for years, you may well look a little deeper than again the cheapest plan or the lower cost network and go with a full blown network. Okay, so. The other thing you want to look at, I guess, on these plans is it an HMO, a PPO, or an HSA? An HMO, Health Maintenance Organization. That is, you have to have a primary care physician or a PCP, and they're like kind of like the coach or the quarterback of everything. If you need to get an MRI or a CAT scan, they have to refer you. If you want to see a specialist, they have to refer you, and you have to go to the person they refer you to. You have a little bit less say. Those plans tend to cost a little bit less. Or you go to a PPO, a preferred provider organization, where you go any doctor you want. You don't need a referral. The cost is usually a little bit more, both for the insurance and a lot of times they have a higher copay on those type of things. But overall, usually a better plan because you don't need the referral type of thing. If you think you want to go see a specialist, you go see a specialist. No big deal. The last thing, and these are plans that are a little bit newer type of plans, called a health savings account or an HSA. They're basically a high deductible health plan with a savings account attached to it. You have to first of all have a plan that's called an HSA qualified health plan, and then you also have to talk to your bank or financial advisor, or sometimes your insurance broker can help you with that as well, on setting up the health savings account. And what that basically does is allows you to put money in this account tax deferred, and you pull it out tax free as well. So that's a nice thing, that nice little thing. And the nice thing about that is the money is not like the flex spending accounts where it's use it or lose it. These you can roll from year to year. So if you put $5,000 in this year and you don't use it, you can put $5,000 in next year and $5,000 in the year after that. If you never use it, then it's never used. So that's a nice possibility there. Also, if you look at my website, www.isellhealth.com, there's a blog on that entitled What to Look For During Open Enrollment. There's also a link to more information on tax benefits of HSAs there. Now, the other thing you need to be aware of is under the law, there are what are called subsidies available. The official term is advanced premium tax credit. Basically, what that is instead of getting a tax credit on your tax return, they're basically giving you an advance on that based upon your income. So now on those plans, you've got to go through the marketplace to get them. An insurance broker can walk you through that as well, but you can't. There are plans called on the marketplace and off the marketplace. Off the marketplace is very quick. For people who don't qualify for a subsidy either because they make too little or make too much, that's very quick. If you go on the marketplace, they can apply the tax credit for you. And what would happen is again, we'll keep the math simple, but if you have $1,000 a month premium and you qualify for a $500 tax credit or subsidy, basically what happens is you see the bill, it'll say premium $1,000, expected subsidy $500, your portion $500. So then you're paying the $500 every month to the insurance company, and the subsidy or the government is paying the other amount on your behalf. So that's a nice little feature. But the income wise for that, if you're a family of one or a single person, if you make less than $46,960, you can qualify. You have to be above the minimum as well, which puts you in Medicaid. But $46,960 for an individual, $62,040 for a couple. A family of three, if your income is under $78,120, family of four, $94,200. Family of five is $110,280, and a family of six is $126,360. So I refer my notes to get that stuff right there. But if you qualify for those amounts, that will reduce the cost of your premium. It makes financial sense for you to try to go through the marketplace. I would also say always talk to your insurance broker. He can help you through this stuff. If he can refer you to somebody who does. There's a lot of good brokers out there. If you don't have a broker, you can find one online. You can call me at www.isellhealth.com. You can refer to my website or give me a call at 888-448-5370. If I'm not licensed in your state, I will help you find somebody in your state to help you out. Look forward to the honor. Again, Eric Wilson, iSelf Incorporated. Have a great day.